While everyone was celebrating the stock market hitting new highs this year, one of the most popular dividend ETFs just posted shocking negative returns. I'm talking about SCHD, the Schwab US Dividend Equity ETF that every dividend investor seems to love, sitting at minus 1.16% for the year, while the broader market soars. But here's where it gets really interesting. Jerome Powell's latest speech at Jackson Hole just changed everything for dividend investors, and most people have no idea what's coming. In the next 12 minutes, I'm going to show you exactly which dividend investments are quietly positioning for massive gains as rate cuts approach, why traditional dividend strategies are failing right now, and most importantly, the specific action plan you need to implement in the next 30 days. Because if you don't adjust your strategy now, you could miss out on what might be the biggest opportunity for dividend investors in years. Let me take you back to August 22nd, 2025, Jackson Hole, Wyoming. Federal Reserve Chair Jerome Powell steps to the podium for what would become one of the most pivotal speeches of the year. Now, for months, Powell had been maintaining that elevated rates were necessary to fight inflation. But on this day, everything changed. Powell delivered the strongest signal yet that interest rate cuts are imminent, stating that the balance of risks appears to be shifting and that current economic conditions may warrant adjusting our policy stance. The market reaction was immediate and dramatic. Within hours of Powell's speech, traders were pricing in an 85% probability of a rate cut at the September 16th to 17th FOMC meeting. This probability has been fluctuating between 82% and 91% ever since. But the message is clear. Rate cuts are coming, and they're coming soon. But here's what's fascinating. While traders were celebrating this news, dividend investors were facing a harsh reality check. The dividend investing playbook that worked for years was suddenly showing cracks. SCHD, with its 3.74% SEC yield and reputation as a dividend stalwart, was posting negative returns. Meanwhile, other dividend strategies were telling a completely different story. VYM, Vanguard's Dividend Appreciation ETF, was up 9.82% for the year. VNQ, the real estate ETF, had climbed 4.67%. Something fundamental was shifting in the dividend landscape, and most investors weren't paying attention. So I decided to dig deeper. I went straight to the source, official data from Schwab, BlackRock, Vanguard, and iShares, to understand what's really happening in the dividend world. What I discovered was eye-opening and will change how you think about dividend investing forever. The data reveals a clear separation between quality and quantity in dividend investing. SCHD, despite its popularity and 3.87% trailing 12-month distribution yield, is down 1.16% year-to-date. This isn't just a minor underperformance. This is a fundamental breakdown of the broad-based dividend approach. Meanwhile, VYM, which focuses on dividend appreciation and quality metrics, has delivered a stunning 9.82% return. That's an 11 percentage point difference between two supposedly similar dividend strategies. But the story gets even more interesting when you look at income-focused strategies. JEPI, JP Morgan's Equity Premium Income ETF, has managed a 4.34% return while providing an impressive 8.40% yield through its covered call strategy. This proves that in the current environment, defensive income strategies are outperforming traditional dividend approaches. The market is rewarding quality and income generation over simple dividend yield. Now here's where things get really exciting. REITs are staging a quiet renaissance. VNQ, the Vanguard Real Estate ETF, has posted a 4.67% return year-to-date while offering a 3.89% dividend yield. This might not sound spectacular, but when you combine it with the historical precedent of REITs during rate-cutting cycles, it becomes a compelling story. Every major rate easing cycle in modern history has seen REITs outperform as borrowing costs decline, property valuations increase relative to bonds, and investor appetite for yield grows. What makes today's REIT opportunity even more compelling is the sector's evolution. We're not just talking about traditional shopping malls and office buildings anymore. Modern REIT exposure spans industrial warehouses benefiting from e-commerce growth, data centers with 95% plus occupancy rates driven by AI demand, and healthcare REITs supported by demographic trends. Lower interest rates provide multiple tailwinds for all these sectors. Reduced financing costs for property acquisitions, higher property valuations, and increased investor demand for yield-producing assets. But here's where many dividend investors are about to make a costly mistake. With traditional dividend ETFs like SCHD struggling, some investors are being tempted by business development companies and their ultra-high yields. This is exactly the wrong move right now. BDCs face a perfect storm as rate cuts approach. Most BDC investments are floating rate debt, meaning rate cuts will directly compress their portfolio yields. Rising non-accruals could translate to realized losses, and payment-in-kind income may weaken cash coverage of dividends. If you're going to invest in BDCs at all, focus only on institutions with debt-to-equity ratios below 1.5x and asset coverage ratios above 200%. Avoid over-leveraged entities like New Tech Business Services Corp., which carries extreme leverage ratios that could spell disaster in a changing rate environment. Let me put this all in economic context. We're dealing with core CPI at 3.1% in July 2025, still above the Fed's 2% target, and headline CPI at 2.7%. The Fed is walking a tightrope between supporting employment and controlling inflation. This complexity is exactly why dividend investors need to be more selective than ever. Now let's get to what you actually need to do. Based on this data, here's your immediate action plan for the next 30 days. First, if you're currently overweight in broad-based dividend strategies, consider rebalancing toward more selective approaches. The data shows us that not all dividend strategies are created equal in this environment. SCHD's negative 1.16% performance in a rising market highlights the importance of being more strategic about dividend selection rather than taking a broad brush approach. Second, increase your VNQ position. Real estate investment trusts are positioned to be major beneficiaries of rate cuts, and VNQ's 4.67% performance combined with its 3.89% dividend yield creates an attractive total return proposition. I'm suggesting a 30% to 35% allocation to REITs, up from the typical 20% that most advisors recommend. Third, maintain your VYM core holding. The 9.82% year-to-date performance validates the quality dividend approach. VYM's focus on dividend growth and quality metrics is exactly what's working in this environment. Consider this your anchor holding with a 20 to 25% allocation. Fourth, consider JEPI for defensive income. With its 8.40% yield and defensive 4.34% return, this covered call strategy offers portfolio stability while generating substantial income. This could represent 10% to 15% of your dividend allocation. Here's your specific timeline strategy. On September 5th, we get the August jobs report. This will give us insight into labor market strength and Fed policy direction. On September 11th, the August CPI report comes out. This is crucial because persistent inflation could delay rate cuts. Then on September 17th, we get the Fed decision and Powell's press conference. Position yourself before each of these dates, not after. Your new quality metrics should prioritize earnings growth consistency over yield chasing. Look for companies with dividend coverage ratios exceeding 1.5x. Focus on sector diversification and avoid concentration in challenged sectors. The old approach of simply buying the highest-yielding stocks is dead. Quality matters more than ever. Consider international diversification to reduce U.S. concentration risk. Global dividend strategies can provide exposure to different economic cycles and currency dynamics. This isn't about timing markets, it's about building a more resilient dividend portfolio. Here's your key takeaway. Quality beats yield in this new interest rate environment. The performance gap between VYM's 9.82% return and SCHD's negative 1.16% tells you everything you need to know about where dividend investing is headed. The market is already separating winners from losers, and those who adapt their strategies now will be positioned for the opportunities ahead. Your immediate action items are simple but crucial. First, audit your current dividend holdings today. Don't wait. Second, increase your REIT allocation before rate cuts become official policy. Third, Focus on dividend growth companies, not just high current yield. And fourth, monitor Fed communications closely because policy changes happen fast. The convergence of Fed rate cut expectations and mixed dividend performance creates both massive opportunity and significant risk. Investors who adjust their strategies based on actual performance data, rather than outdated assumptions, will be the ones who profit from the changing interest rate environment ahead. Drop a comment below and let me know. Which dividend ETF has performed best in your portfolio this year? Are you planning to increase your REIT allocation? I read every comment and respond personally. If this analysis helped clarify your dividend strategy, hit that like button and subscribe with notifications on. I'll keep you updated the moment Fed policy changes or when new dividend performance data comes out. The next few months are going to be crucial for dividend investors, and I want to make sure you're positioned for success. This video is for educational and informational purposes only. Investment performance shown is based on historical data and projections. Past performance doesn't guarantee future results. Always conduct your own research and consult with a qualified financial advisor before making any investment decisions. Thanks for watching.